At the beginning of our show, we always like to do a summary of kind of what we saw happening in the stock market this week. And so let's take a look at our uh, our chart here. So pretty good week so far.
Yeah, like a record-setting week, you could say.
Yeah, last Friday was fun because right at the end of the show, we closed. The market closes at 1 o'clock here, and we closed at the all-time high for the first time in a little over 2 years, and we've done that every day since Monday, Tuesday, Wednesday, Thursday. Just before I came into the show here, we were a little over break even, so we might do it again today. We'll see what happens. I think Intel today, the report from Intel kind of brought the market down. It was up like 0.5% this morning. And so what's been happening this week, there's been some good data that's come out that's really kind of driving the market. And one thing I want to talk about, because this doesn't get talked about enough, is that the data that's coming out now that is good is the reason the market has been going up.
Yep.
Not particularly the reason the market is going to go up. And this is a distinction that a lot of people don't understand. The market is a leading indicator. The leading economic indicator, LEI, is a basket of 10 different indicators, and the S&P 500, which you're looking at right here, is one of those 10 because it has a propensity to lead the economy, right?
Yeah. You buy for the future, you don't buy for the now.
Yeah, so hey, we set a new high every day this week. And so to me, that does mean that there's some follow-on aspect of that the market is telling us that things are going to be okay. And it's been telling us that for quite a while, right? And if we go back to October of 2022, the 13th is where we hit that low, in that downturn. We had that big 10% drop last summer, ended at the end of October. But generally speaking, we've had this primary trend to the upside, even though everybody was saying it wasn't going to do well, the market was going to do poorly, the economy was going to do poorly. And we'll cover some of the numbers here. And here's a big thing that I've been talking about so far this year is that I'm running into an awful lot of people who still think the economy is doing poorly.
Yeah, there's kind of a disconnect how the stock market, the economy is doing, and how people feel.
Yes, definitely. Now, part of the reason I think people feel the economy, and just my experience of talking to my clients, that they feel the economy is doing poorly is because they're seeing costs go up at a fairly rapid rate, and that's making it difficult for them to have the same standard of living that they're used to because, everything that they're going to the grocery store, the electric bill comes in, all these things are higher.
When your purchasing power is getting eroded, you don't feel as good about the economy. You don't feel as comfortable.
That's right. And ironically, one of the reasons that you might see higher costs is because the economy is actually quite good. Because when the economy gets hot, the demand can outstrip the supply. In this particular case, the supply was subdued due to the pandemic, right? And so supply of goods was subdued, and so people were kind of bidding up, the refrigerator or whatever they were doing, their kitchen remodel, right? And then after we got out and got to do services, there weren't enough people working in these places. And so we had subdued, employees, really, in that case. Those have started to ease and ease and ease. And so today, the reason the market was up, 0.5% right away was because we had the PCE, Personal Consumption Expenditure Index report. And so this is a chart that kind of shows what was happening here, in the last, since 2020. And you can see that big jump, right? Big hump. And so what happened was, we'll put out too much money, most likely, right? Combine that with the, the pent-up demand of being locked up and people wanting to do things to feel better. And then as soon as they can get out, getting out and travel, right? And we ended up, that combination of wanting to spend money, even if you didn't have it, and having a lot of money because the government was putting it out, and then a restricted supply because of a pandemic, you had very high inflation.
Yeah, because people weren't able to spend on travel or stuff like that, so they saved a lot of extra money, and now it's kind of burning off the reserves.
Yeah, exactly. And so there's several lines here. First, the dark blue line shows the change from the year earlier. So the report today showed that the PCE index, and again, this is the core portion. This doesn't include energy and food. And the reason we talk about core is because this is what the Federal Reserve looks at. They're not looking at CPI. They're not looking at top line inflation. They're looking at core PCE, right? And when they're talking about 2%, and so that yellow line there, that horizontal yellow line, is the Fed inflation target at 2. And so we're still above that compared to last December, right? 2.9 versus 2. But if you look at the last 6 months, which is kind of that greenish line, that's actually now below 2%.
Yep.
So at 1.9%, take the last 6 months, multiply times 2, it's 1.9%. We're rounding here, but nonetheless, it's already below that. And if you look at the last 3 months and annualize that out, we're actually at 1.5%.
Yeah, which is a bit too low.
That's right. And so if you look at what the Fed looks at, they don't really like to see inflation in this particular case get below 1.75%. And so that is an issue for the Fed because they are, as nervous as they are about inflation, they're actually more nervous about deflation. At least that's what we've talked about in the past. And so you'll actually see, you can see a deflationary trend there, where it got down, below zero back in the pandemic when things were really locked down. And that's why they took rates to zero. It's why they started to buy literally billions and billions of dollars worth of bonds, on the open market and what have you too, what's called quantitative easing, to try to push away from that. Of course, doing quantitative easing, lowering to zero, and the Congress putting out tons of stimulus created the opposite effect. We ended up one of the greatest stock market runs really in history, and then of course that created this inflation, which has created this downturn. So now inflation is really subdued. The argument is now, when are we going to have a rate cut? Right? And so the market, for a point in time had over 80% chance that we would have a rate cut in March. Now that's down to kind of 52%, sort of a coin flip. Right? Not so sure on that. Although I will say, if you look at the last 3 months and we're hitting at 1.5%, if we continue to see numbers that drop, maybe by March, we do see some, at least consideration. Because right now, the Fed governors are talking about rate cuts in kind of that July to September timeframe, right? And I would think the market won't like that. It didn't like the fact that the Fed waited so long to raise rates. And part of the reason we have this higher inflation is because they delayed rate increases. You could have kind of a soft economy, a really soft economy, if they leave rates up too long.
Yeah, so the fear is that they're just not reacting in time.
Yeah, exactly. So these are things, we can look at, what's happening with the economy and those type of things. But you look at the stock market, the expectation right now is that they're going to be lowering rates at some time in the first half of this year, definitely. And so that's where you could get a hiccup, right? The market's moving along because they're going to be lowering rates, and we got a good economy and what have you, things are happening, and all of a sudden, they don't. And so I think that will be a picture. However, I don't think it'll be a big picture. This is the 5-10% type of correction that would happen. This isn't the 2008 thing. These aren't the big ones, okay?
Nothing systematically is breaking in the system. It's more that there's slight corrections.
Right. Something could break. And if they leave it up long enough, maybe that happens, and you got some of these companies that are kind of teetering, with their high debt levels and those types of things. But so far, and again, this is back to one of my themes, is that 2008, Lehman Brothers breaks. They don't bail out Lehman Brothers. We end up with a 30% stock market drop, and we end up putting out like $7 trillion worth of stimulus to get us out of that. And this time, last year, regional banks basically break, right, under the load of the higher interest rates. And what do? They set up a special lending institution for those banks and basically throw money at it. They didn't let it fail. They let some of the banks fail, but they didn't let the system fail. And the market just basically took off. We had a 24% year last year because of that, instead of the big downturn that everybody was expecting after something broke. And what I don't think what they're realizing, there's two big things that are my theme. Number one, they're not realizing what a pandemic does to the finances and how much pent-up demand and how much people are willing to spend. And consumer spending is driving this whole thing. And number two, they basically don't realize what the government has now discovered they can do, especially in an election year, right? We're probably going to see some type of money come out if there is something that breaks this year. All right, so those are two key points. I'll keep bringing them up because they're the reason Wall Street missed this last year.
Yeah, there's an old adage, you never bet against the American consumer. Americans tend to spend more than they save.
Oh, yeah. Yeah, it's weird because if you look at emerging markets, they save at a much higher rate, and you think, well, that's kind of strange. Those are poorer countries in general, but they don't have the safety nets, right? They don't have the medical insurance like Medicare or Medi-Cal, those type of things They don't have Social Security oftentimes and what have you too. So people are more dependent upon themselves. When you put in more safety nets, people feel like they can go out a bit more because they have something behind them. That's the theory anyway. All right, so then the other big report that came out this week was the gross domestic product. And this is the thing that really kind of jumps out at me, because this is the essentially overall health of the economy, right? As we sit now. Now, this, again, stock market's predicting right now, in my opinion, a continued growth that is, good. So our average is around 3.2% is my memory over about a 10-year period. And you can see back in, 2021, we had some really good growth going on. But if you look at what happened here, we just had a 3.3%, gross domestic product for the fourth quarter. Yeah. So they basically take the quarter, look at it, and they annualize it. If we keep doing that for the next, 3 quarters, this is where we'll be, 3.3. And if you look at the third quarter, we were at 4.9%. So for the second half of last year, we had 4.1% growth. That's actually phenomenal. And you had inflation coming down. That's not even a soft landing. That's actually a no landing scenario.
Yeah, which would be if the Fed pulls off a no landing scenario, everyone's really happy with that.
Yeah, because soft landing is super rare. I think the last one was 1994. So to have a no landing scenario, and again, government spending that comes in at the appropriate time and pent up demand is kind of the two things that are kind of making this work. And people are willing to go out. I mean, we were talking about it before the show, credit card debt's growing, at a fairly high rate.
Yeah.
And Ethan was asking me, when can that stop, right? Because when do they hit the wall? I'll tell you what, one thing I've learned over the long term of watching the stock market and watching spending and watching the economy, things can go way longer than you think. Yeah. I mean, the 2000 run up, and it's incredible because sometimes logic just starts flying out the window.
Yeah, the market sometimes is played by human emotion.
Yeah, that's right. And eventually there is some point in time where that happens, right? It really does. And so that's why we ended up with a downturn in 2000, a downturn in 2008. I mean, people were buying houses they shouldn't have been buying, right? They kept going and going and going. It was incredible to watch that happen. And so, it could go on for 4 or 5 years before you end up with that. It might not, but I'm just saying you've got to be aware of. I keep hearing people on the TV, CNBC or whatever it is, talking about how, it's already too high, or oh boy, I tell you, they could be really wrong there. It could go a lot higher, and we're at an all-time high, but really we're just recovering kind of what we lost over that 2-year period. And so during that period, companies continue to increase their earnings. Yep. And, so things are not cheap by any stretch of the imagination. But, there's some expectations, I would assume, because the market keeps going up, that earnings will continue to grow. We have had a lot of earnings reports this, week. And, we're in earnings season. And so Tesla, missed their numbers, had guidance that was worse than expected, right?
Yeah, it's been hit or miss. I'd say there's been a lot. When the misses have been, there've been pretty major companies that have been missing. You got Intel missed today too. Yep. It's a lot more. It's not they're missing on their actual earnings. It's kind of them lowering their forecast for the next year, their forward guidance, and that's what really concerns investors. Yeah,
exactly. Because Tesla did, okay on their earnings, a little bit of a miss, but then their forward guidance was worse, right? And now, having said that, there's a lot of companies done very well. I would call this a medium earnings season so far. Not great, but not bad either. And again, the market is setting all-time highs every single day. It is trying to tell you that things are going to be okay here in the near-term future, and that's what the market tells us. It's why it's going up. It's not going up because we did 3.3% gross last quarter, on the gross domestic product. That's why the market was going up before that, right? Now it's going up because there's some expectations that earnings are going to continue to grow. The Federal Reserve might be lowering rates this year. They might be lowering rates just because they're, and to me, the ideal scenario, because I can see 2 reasons you lower rates. One is a recession, something breaks. The other one is deflation, right? Lowering for deflation, that's a good sign. I think that would keep us rolling.
Yeah, because you're actually, when you lower for deflation, you're actually trying to increase the economy's
Yep.
growth rate.
Yep. And you would be talking up the economy. You would be talking up the stock market. I was telling Ethan before the show, I think the Fed stopped talking negatively about the markets and so aggressively, because one of the reasons that you would do that is because if you see things starting to slow down, you want to not have to change rates, then you let the market change it. And one of the ways you do is you let the market run. So the bond market goes up, the stock market goes up, people feel more wealthy, basically are adding liquidity to the system without having to change the interest rates.
People spend money when they feel good.
Yeah, they do it the opposite way also. You know, talk up the interest rates, talk down the market, tighten up liquidity, right? I think right now they're actually trying to make more liquidity available in their talk, in their rhetoric, so to speak. And so, you know, we'll see how that plays out, but that's not a bad scenario. One of the things that happened, again, this is a pandemic-related inflation event, and as this money burns off that they sent out, you've got a scenario where more supply is coming online. You know, there's more oil and gas, there's more, you know, restaurant workers, you know, whatever it might be, more people coming back into the workforce, and all of those things are really happening. So, you know, just to finish up, just one last comment. So we got great growth in the economy for the last 6 months. We have 2% or less inflation on the measure that the Fed looks at. We have low unemployment, right? We have consumer spending that is really, really good. We have wage growth that is now higher than inflation and has been for most of that 6-month period, actually. Now, wage growth lost for a while to inflation. So we're making up, but we are making up. And so I think that's why consumer spending continues to do well.
Yeah, they're feeling better and better about how far their paycheck goes.
Yeah, so, I mean, if you're feeling like the economy is doing poorly, consider some of those pieces and consider some of those things that are actually happening and how things are rolling. Look at the stock market. The stock market is trying to tell you the economy is going to continue to do well. If we close today at a new high, that'll be what, the 6th day in a row at a new high, 7th day in a row up. As far as that goes, are we up so far?
No, we're down a little bit.
A little bit. All right, we'll hold our breath for the end there and see what happens. I will say, looking at the last couple of days, I'm seeing some fatigue in the market. Even though we did end up on those days, we were up quite a bit higher during the day and then kind of came back down. To me, that's sort of a topping sign. I would not be surprised at all to see some softness come in here someplace for some reason, maybe some other earnings reports that come out. I wouldn't even be surprised at all to see us retrace all the way back down to, you know, the top of the all-time high. That would be normal. That's how it works usually. This market is pretty hot. It might not do that, but that would be the norm. So anyway, that's what's happening right now. A good time to be an investor. Great time to be using a momentum system like we're using right now, and really you can ride these waves. This is a good time for the market. So. Anyway, look forward to being able to, you know, discuss this again next week and cover our summary. Thank you for listening this week. And so